Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with Mark Dow. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. Now, if you're enjoying the show, everybody, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. Today I spoke with the head of Dow Global Advisors and behavioral macro blog and Twitter feed, Mark Dow. I kicked off today's show asking Mark if he thinks the coronavirus is the only reason we're seeing the market sell off, or was the market already in process of topping and the coronavirus was the push that triggered what was already going to happen. Mark explains why fiscal policy is more important right now than monetary policy. He explains why he believes that gold and Bitcoin are not a hedge or safe store of value. Tells us what he is trading right now and his process for looking at some investments during this time of crisis. Last but not least, we talked about liquidity in the bond markets and his thoughts on the recent sell-off in crude oil. So without further ado, let me take you right to the interview with Mark. Mark, welcome back to the show.
Thanks, Anthony. Thanks for having me.
Great to speak with you, my friend. Thank you so much for taking the time to come on the show on a Saturday. And, you know, there's a lot to talk about today, Mark. I mean, obviously a lot going on in the markets. And before we get into me picking your brain about a lot of these things, because really you're one of my go-to people to make sense of a lot of what's happening, because I think that everybody could be so overwhelmed by all of the different news and headlines and services and everybody telling everybody what's going on. I think that you do a great job of really making sense of it, at least for me. So what I want to do is I want people that maybe don't know you and your background, for you to just start off by just telling us what your background is so they can get a sense of where you're coming from with all of these things that we're going to talk about today.
Great. That's perfect, Anthony. Let me start with, well, first of all, there may be some noises in the background, animal noises here in the office with me. So bear with me on that. I'm a sixth generation Californian, maybe start with that, very proud, and happy to have been able to come back to my hometown to live. I have kind of advanced degrees in international political economy, and I spent the first part of my career working at the Treasury Department and the International Monetary Fund, specializing primarily in debt sustainability. I went around the world figuring out countries in crisis and what policies got them there and how they might fix them and how we could help them. Been to like 80 countries. So I've seen, it's like a doctor who has spent a lot of time in the emergency room. You start to recognize patterns a little bit better on the political economy front. After that, I was plucked out of the IMF to a mutual fund in Boston as a sovereign analyst. And pretty soon I ended up managing money, emerging market debt fund, and then other funds in the fixed income area. After some time, the next big challenge was global macro. That seemed to me, they always said economists can't invest very well, but certainly they can't trade. And that seemed to be the next challenge to take on. So I did. I worked for 7 years at Faro, a global macro hedge fund in New York. And since then, I've come back to California and, running money for individuals, although I've been giving money back over the past few years for peace of mind and quality of life and for no other reason. And writing on the behavioral macro blog and running a behavioral macro Twitter feed, which is kind of private, subscription based. It's not very expensive, and you can come and go as you please. But the idea is to share some of my knowledge with people who want to get up that curve faster and don't want to learn by getting repeatedly punched in the face the way I did. One more thing I should add in my Treasury experience. So I've worked for 3 different administrations, both Republican and Democrat. And that really helps to see both sides of the equation. I worked for Bush Senior and I worked for Clinton. And then as a young guy, I did an internship at the tail end of the Reagan administration in the office of the trade representative office. So that gave me an appreciation for a lot of politics. And for those who know my feed, they might be surprised, but I started as a registered Republican and I've been independent. Starting probably 20 years ago, I became independent and have stayed that way ever since. So that's kind of the filter of through which you should see where I'm coming at these things. Though in my behavioral macro feed, you'll see that I'm pretty scrupulous at separating politics from my analysis in a way I don't on the Mark Dow Twitter handle feed, just so you know.
You explained a lot about your financial and macro background, but also with the current events that we're seeing right now, you actually have very close ties to Italy as well.
Yeah, so I married an Italian girl many years ago when I was a graduate student, and from Bologna, Italy. And her parents are aging; they're in their 80s. Mom hasn't been well for a number of years, and they've been homebound. And she's been going back and forth and helping them out, and she's kind of stuck over there now with them on a lockdown, and it's pretty serious. It gave me a bit that coupled with a few people on Twitter who, I like a lot of people, I was skeptical at first because we were only hearing from the perma bears who shout from the rooftops that the sky is falling at any new news item, and fading them has been kind of the money trade for the past 10 years. So I was initially skeptical, and then I saw people that aren't that way starting to ring the alarm, and I was able to see how things were progressing in Italy. And when the facts change, you change your mind, right? And that's what I did. So it got much more serious. The other factor behaviorally, because in my when I got to markets, I realized that things work differently from the textbook, very fast. Behavioral economics and behavioral finance really was the prism through which you should analyze these things. And I know that we tend to overstate the imaginable risks, typically things that we have seen in the past or read about, and we underestimate the severity of unimaginable risks. This is an unimaginable risk. So we haven't even thought through the economic ramifications for the supply chain and just concrete things. People stop paying other people, and there's a cascading effect through the economy, and it can be very serious. And our economy has gotten much more financialized and much more complex. So we don't know what's coming, but like I always say to the guys who follow on behavioral macro, open mind, open eyes, and just be ready.
Yeah, absolutely. I mean, every single day when I sit back and I do my meditations and I just look back at the day and the market and the headlines and, when I'm walking my dog, and I think about how many things this could impact, it's just like my brain just starts racing about more and more things. And I actually want to start off with something that I was with 15 traders the other day. We were all sitting down at dinner, and a big part of the conversation was, now a lot has changed in the past week, but I think this conversation is still probably happening amongst a lot of traders and people out there. Is coronavirus the trigger that exploited the weakness that we were already going to see in the market? Because in my experience, a lot of times you'll get a headline and that will just be the push that the market needed. Obviously, this is a lot bigger than a push at this point, but is the coronavirus the main reason we are seeing this action in the market?
It's a little bit of both. And I think the way I look at these things is I kind of look at through a Minsky prism. I don't know if your listeners have heard of Hyman Minsky, but he was a famous economist who wrote about, he had the famous phrase, stability breeds or leads to instability. And that is, and we know this from our time in markets, Anthony. You've been around long enough to know this too. We start a cycle with people not taking enough risk, because we're afraid. And no one wants to take liquidity risk, committing to an asset for an extended period of time. And we end the cycle with everybody wanting to commit. And this happens irrespective of Fed policy, happens irrespective of fiscal policy. It's just human nature, right? Everyone thinks that low interest rates trigger risk taking. They certainly don't hurt it, but what really triggers risk taking, and we've seen this time and time again, is one, do you feel secure in your situation? Do you feel safe to step out and take some risk? And two, do you see people around you making money, right? I mean, this is why in the financial crisis in 2008, we saw crazy lending going on in 2006 and 2007 when the Fed funds rate was already at 5.25. It wasn't the price of money. It's because it's because Merrill Lynch saw Goldman Sachs making money and wanted to make the same loans, and they did it more aggressively. It's because my buddy, who I grew up with, saw people who he thought weren't as smart as him taking leverage bets on housing, and he said, "Oh, I'm going to do it more aggressively because I'm smarter than they are," and got levered up with neg am loans, right? Yep. So that's the big process. So we've been in this thing for 10 years, and little by little, layers of risk get built into the system. And so the way I look at it, when we started the process in 2010, 2011, the punchline I was using is when people said, "Aren't we going to have another recession? Aren't you worried? Aren't we going to have Lehman 2?" I said, "You can't commit suicide jumping out of the basement window." And with every passing year, we go a couple floors higher in the building as we get back to normal risk taking, and the pendulum swings into excessive risk taking. Now, the further you are in that pendulum from no risk taking to excessive risk taking, the smaller the trigger need be to get you to unwind. So you would need something massive in 2011, say, or just pick a time, a much bigger shock to get the same kind of sell-off that you could get today after risk has been quietly building for a number of years. I think that natural process, that Minskian process, is the bulk of the reason why we're seeing this. And the coronavirus is clearly big enough a trigger to get that to unwind. So rather than, a lot of guys have been saying, "Oh, this is just a Fed-induced artificial stimulus, and it's all going to come crashing down." It's going to end badly. Every cycle ends badly, irrespective of the policy stance. It's just our nature. And it's a miracle, really, that this, well, not a miracle, but it's kind of impressive that the cycle has lasted so long. In part, that's because people had PTSD from the last crisis and were slow to take on risk the way they might have been in a previous cycle. But a lot of that, I think the policy responses have been on the whole pretty good. So it was going to happen sooner or later, and the further and the longer you go, the smaller a trigger you need to get this thing to get the avalanche to kind of start rolling. And I think this has done that. The risk cycle now, you can say, is over.
Yeah, I mean, every breakup ends badly. I mean, it's just the reality, right? And I agree with you on how the longer something goes, the more fragile it is to break at the end. And yeah. I want to go to your pinned tweet. I always like going to people's Twitter accounts and see what their pinned tweets are. And in yours, it says, inherit a 2% economy, dump a boatload of other people's money on it, get 3% for a year or two, claim it's the greatest economy the world has ever seen. And when the turbo fiscal boost rolls off and the economy starts to slow, blame the Fed for not keeping interest rates at zero.
Yeah. That was a fairly political tweet in a sense because about the policies in the current administration. And there, in that, though, there's the analytical basis of one, we did not get much for our fiscal stimulus, right? And that's pretty evident. And it wasn't the trade war. We were slowing down before that. If you look at the path, you can see as fiscal policy rolled off, the economy slowed down. So we got, the idea is you provide fiscal stimulus when the private sector isn't willing to take risk because it's just had a shock to its risk appetite. And then as risk appetite normalizes, you back off of that. That's the right policy response, right? And it's not always pumping up the economy with fiscal spending. So it wasn't the right thing to do at the time. Not that, I'm not one of these people who worries too much about the debt or the deficit, but it is a problem when we're not spending it in a quality way, and we're not spending it at the right time. So, the fiscal timing was wrong and irresponsible and self-serving. The second, fiscal policy is more important than monetary, even if for a short period of time it does move the needle. You can give someone more money, but they still need risk appetite to go out and spend it. So cutting taxes, as we saw, when you do that, people just put the money in their pocket unless they really want to take risks. Same thing about the Fed and liquidity. People think, oh, they're pumping liquidity in the system. It goes into the stock market. Well, if you just change instruments, if you give me cash instead of a bond, you're not going to turn around and buy Tesla stock with it unless you're really crazed with risk appetite. So you just got to understand these mechanisms properly.
Yeah, that's something actually I learned from you, and you've talked quite a bit about this a lot over the last several years. And
incessant.
Yeah, and the other day, another tweet that you put out was you said that a Fed policy response is coming, but this ain't it.
Well, I meant a policy response is coming, but this ain't it. And that is, we need a fiscal, monetary policy can't really help us here. All it can do, and the Fed is focused on this because of the last crisis, is to keep the plumbing clear, right? They want to make sure the markets are working as best they can. And there's some issues with that we can talk about because we're working under an entirely new architecture that has not been stress tested. But their radar is up, and they're watching it, and the banks are much better capitalized. But there are going to be plumbing issues from time to time, as we've seen in the long end of the Treasury curve, that are going to have to be addressed because maybe they're bumping into some of the new regulatory requirements we put into place to make the system better capitalized. But I'm sorry, the tweet with I lost track of the tweet that you were referring to.
So I'll read it again. I said.
Okay.
The tweet you put out was a policy response is coming.
Oh, right.
But this ain't it. And you said all the Fed could do is ensure the plumbing works, and they're all over that, but they can't make you take risk.
Yeah, I got a little lost there, but yes. So the second point there is Fed can't help except keep the plumbing clean, and the response has to be fiscal. And I think it kind of doesn't matter a whole lot right now because the economic response is secondary to kind of the crisis, the virus crisis. But if there were to be a tagline about how to deal with this thing from a policy standpoint, and not just them, but also us in our behavior, it's we got to shut it down, protect the people on the front line, and get economic assistance later to the people, the workers and the people most disadvantaged or hit hardest from the loss of income. And that includes parents, working parents with children. This is going to be particularly difficult to manage for them. So, shut it, because the more aggressive our response in shutting this down now, the better we'll be able to, the more time we'll be able to buy, and the better we'll be able to manage it, not just in terms of the capacity for the healthcare system, which is critical as we're seeing in Italy, but also maybe they'll come up with better treatments, and maybe even they'll come up with a vaccine. So buying time, there are a lot of people who always say rip the Band-Aid off, no matter what the issue is, particularly in finance, but very often buying time is the right response. So stop it, shut it down now, protect the front line, compensate the people hit hardest economically. And I think that's kind of where we need to go. And fiscal policy can only do that last element, right? It can really only address that last element. Monetary policy is not going to do it because you can put as much liquidity in the system as you want, but people aren't going to use it unless they have risk appetite. And we've seen this time and time again.
So what I'm getting from what you're saying is the most important thing right now is buying time, right? Get through this, because this is something that we do see ending. So it's about getting through this at this point in time. Of course, the health side of things is number one priority, but when we talk about the economy side of things, we've gotten a couple of things so far, and I'm going to see what you think about them. And we had this the surprise 50 basis point cut by the Fed, and then yesterday I watched a lot of Mnuchin, and he said the benefits in the virus relief package for small business are going to be just for the companies that are 500 and smaller. What are your thoughts on what has been done thus far and what you think should be done next?
Well, I think the people much better qualified than I am to say what the micro policies should be. And what's been done so far isn't that important either on the economic front. The important thing is that the government send the message that, hey, we got this. We're going to fix it, right? As best we can. Work together, get through this. It's not going to be over for a long time, but we can get past the crisis phase, right? And then manage this thing. And it's going to be running through the virus is going to be running through the economy for a long time. The numbers that 40 million people eventually are going to get this, right? We want to stretch that out so as to buy as much time as possible. The economic stuff can wait, but we need the messaging that, hey, we got you, so that confidence can return. We're doing the right things. We know it's going to be a fight, but we can get through it. That kind of wartime footing.
Yeah.
And that's the message. And I think Mnuchin wasn't bad on that. And the details don't matter. They will fix them as they go along. The important thing is to send that message. And unfortunately, we were about 3 weeks late in doing it. We were told it was contained. We were told that there are 14 cases, probably going to zero. We were told that there would be test kits for everyone. We were told a lot of things that turned out not to be true. And that undermines confidence in policymakers. What was great about the financial crisis in 2008 is Bush dropped his ideology and said, screw free markets. We got to fix this thing. Tell me later how you did it. And guys like Bernanke and Paulson and Geithner were out there on the front lines trying to send that message that we're on top of it. It took a while for that to get through because we were in free fall and a lot of people were skeptical, but it finally got there. But it's really confidence. So from a market standpoint, what I always say, it's you don't really have to see light at the end of the tunnel because markets are highly anticipatory. And there are a lot of false starts, but one of them ends up sticking. We just need to know that there are reasons to believe there might be light at the end of the tunnel soon, right? Just that confidence, just that the rate of change things aren't worsening at a faster rate. All they have to do is worsen at a slower rate. Kind of when a stock doesn't go down on bad news, right?
Yeah.
That you're getting to the end. We need that kind of confidence shock. And I think it will come. It's just when you're 3 weeks late in a dynamic that is exponential, we've lost a lot of ground, and we're going to end up doing a lot of damage for that delay, in my opinion.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. You mentioned the financial crisis. I mean, a lot of people are comparing what we're seeing now in markets. When it comes strictly to markets, what happened then and what's happening now. And something that you talk about is how if people haven't figured out that gold and Bitcoin are not a hedge or safe store of value, that people need to start rethinking that.
Yeah.
Talk to us more about that.
Well, one, I just don't believe Bitcoin is real. It's been around 10 years and still doesn't have a use case beyond black market purchases. And there are guys who tell themselves a lot of stories about what it can be, but really they just want to get rich quick. That it's a speculative vehicle, right? And they can even delude themselves that these things are real. I'm not saying they don't believe these things that they're saying. Obviously, some don't. There are a lot of scams and promoters in the space, but it doesn't seem to be there for me. So that's that, and we're seeing that, I think, in the price action. On gold, it stopped being a monetary asset when Nixon closed the gold window back in 1971. But old habits die hard. You know how it is with traders. I remember, Mexico, after doing, everyone used to look at Mexico when they used to trade the currency as an oil producer, right? Because Mexico produces a fair amount of oil. They still do. So the currency, the Mexican peso would trade along with the price of oil. Well, it stopped in 1994 being an oil economy and became a NAFTA economy. And not only that, if you look at their balance of payments, they import more petroleum products than they export crude. So they're actually net importers slightly. So they're not a petroleum exporter at all. It does matter a lot for their fiscal accounts, but that's a totally different issue. When you're trading the currency, you need to look at the balance of payments primarily. And there's still people saying, and I think it was Scott Minerd on TV referring to the peso as an oil currency, right? It's been since 1994. Old thinking dies hard, and it's the same thing with gold. So with each generation, new traders come up and they look and they say, oh, that a lot of people are clinging to old ideas. But the younger guys can recognize that those old ideas don't make sense. So they adopt what makes sense. But the old guys kind of, you know how it is. They stick to those ideas. This is why they say science progresses one funeral at a time, because the old guys don't change their mind, but the new guys coming up have the freedom to choose what makes most sense to them, and they're not wedded to any particular set of ideas. And I think that's what's happening here with gold. People are going to realize it's no longer a hedge, it's no longer a monetary asset, and it's going to be less desirable. I think that's how it's going to be a long path. I think, but I think that's what's happening. In 2008. Gold fell 35-40% in the most intense period in the crisis, and then you get people saying, "Well, because it is a hedge. People were selling it to raise cash, and that's not a hedge."
No,
losing 35% is not when the market goes down 35% is not a hedge. I think they're again a little bit like the Bitcoin guys. They're telling themselves stories that they want to believe, and they're drawing their analysis from a period that no longer exists.
Yeah, I mean, because I think that as traders, I look at it as there's no real hedge when everybody all of a sudden is starting to lose in one position and that position isn't performing enough to outpace the loss. All of a sudden, nothing is safe. I mean, and for me, I've learned over the years when I see everything going down at once, it's just everyone's just selling whatever they can get their hands on, and those are days you don't want to fade.
Exactly. Texas hedges don't work. I remember on February 20th when I realized that we were pricing in kind of a zero probability of a coronavirus problem, and there were some political things on the horizon. Bernie Sanders, and we were priced for perfection, and I saw some things that could disturb that. I told guys, don't hedge. Over on the behavioral macro feed, reduce gross units, right? Don't add hedges to protect your existing position. Just reduce your positions, and then respect your stops on the way down, and taking some of those stops was painful, right? But you take them. I took them, and then you feel a lot better a week later. So that's how cash is your only protection. There's some hedges that work at certain points of the cycle. So back on February 20th, I shorted some NASDAQ, not aggressively, but I shorted some. Mostly I just took down gross units, and I just shorted some NASDAQ, but it wasn't as a hedge as much as to make money, and then I worked my way out of those. I took those off over time. But later, everyone is shorting NASDAQ and S&P futures at the beginning, and they work quite well as a hedge. But towards the end of a kind of before a bounce, towards the end of a particular downdraft in a bear market, you see that your hedges, these super liquid hedges, aren't working as well as they were at the beginning because they're so crowded. Everybody is already short, and what people are selling is those illiquid positions that they were holding on to before. So, before you were perfectly hedged going down at the beginning, maybe even outperforming, and then towards the end you realize your hedges aren't working at all, and sometimes they can even go up in your face as your positions continue to go down. And it's one, that's a lesson about hedging, and two, versus reducing gross units. And two, it's a lesson about looking for indications that we might be close to a bounce, and it's dangerous to press shorts.
I want to stay on gold just for a second. And you got a lot of the gold bugs out there that will say, well, look at it in 08. Yeah, you and I just talked about how when things get bad, when what hits the fan, everything is going to go down. But then eventually gold rallied. Throughout that time, I would say that wall of worry that we were in equities the whole time, people kept buying gold. I think a lot of people are saying that, that could be exactly what's setting up again now. Gold's coming down initially, but as we start to move forward from here, as we ride this wall of worry, because let's face it, for a good period of time now, even if the markets stabilize and start to go up, there's going to be that wall of worry along the way. And the gold people, the people that are the gold bugs, that are saying you want to be long gold.
Okay, I can see how a lot of people would think that, but I would be willing to bet aggressively that the fewer people think that this time around than last time because of the experience in the intervening period. When gold went down last time, the monetary policy response was aggressive, unprecedented, and unimaginable. Right? They cut rates to zero, started QE, and people believed at the time, much more than they do today, even though there's still a number of people who believe it, that the Fed could inject this money into the system and it was going to force things to go up. And they didn't understand that notion that people need to be willing to take risks to get that to happen. Right? So people said gold is going to go up. There's going to be, and how many people believed, Anthony, that there was going to be inflation after what the Fed did in 2008? I remember having a meeting with a prospective investor in the hedge fund, saying, Mark, I told him my views on inflation. I said, they're printing money, if you want to call it that, but it's not going to cause inflation. I explained why. And the guy went back to the family office that had sent him, and they called the owner of the hedge fund that I worked for and said, Mark's really smart, but on this, I think he's just out to lunch. He's a little crazy. You got to rein that in. It could be dangerous for your book. And the thinking was that strong. It didn't happen, and people noticed it didn't happen. So there's a lot of learning by doing. And the monetary stimulus is not unprecedented. We've already seen, when QE3 came, guess what happened? That was the top of gold. That's when the bubble broke. So I think a lot of, little by little, people will learn. It's a little bit like, a bouncing ball. You drop a basketball, and each time it bounces a little bit less high if you don't touch it. And that's how these waves kind of go through. Some people will think gold is going to perform that way, so you might get some of it, but it won't be as strong as last time, and it won't work. And then the next time, less, and the next time, less, because people are learning by doing. The only possible hedge that you can believe gold works for now is inflation, and I don't even think that works. But we're probably not going to get inflation. So, though I'm sure some people are thinking along those lines, Anthony, I just don't think I don't think it's right. That doesn't mean it doesn't go up for a while. That could happen. But I think what we're seeing right now kind of tells us, right? Kind of tells us. I just don't think it's going to be that way.
And I agree with you that this time around, there's going to be less people that believe that, and maybe not necessarily don't believe that, but I think gold is getting diluted by Bitcoin and all of these other different ways that people are looking for these stores of value. So the pool, no matter what, I think has shrunk just because of those things.
That's exactly the dynamic. And as a trader, what that means. If there are less people willing to express their view and express it forcefully, then all the hedge funds that you remember, all these guys, Paulson, Klarman, all the big name hedge funds at the time. Who else did? But there's a long list anyway that were setting up rooms with gold and things like that. They all got burnt, right? They got burnt badly. April 2013 is a month they're going to remember for a long time. So it's as gold as a monetary asset is further and further in the rearview mirror, less people are going to reach for it in times of crisis.
You mentioned that you shorted some NASDAQ. What other things have you been trading during this time?
So what I do, as I said, I've been giving money back to other people, but I have two styles. One is investing, and the other is trading. Right? These are the two kind of products I set up. And the investment, basically, the investment side, mostly longer term money. But when I saw this coming, I de-risked, kept a couple of positions, kept 4 or 5 positions, and since then have stopped out of like 3 of them on the way down. So that's fairly static, and I'm really focusing on the trading. And there I trade liquid futures. You can get, mostly S&P and precious metals, because those are the ones I understand, where I understand best the investor base. So what I would recommend to a lot of guys is focus on fewer instruments, deeply get to know their rhythms, get to know their correlations, and when those correlation regimes shift. So an important point came a couple of weeks ago where gold had rallied a lot. It had a nice rally since August, even in a good market, and people continued to add to it aggressively as the market started to break down, right? Because they thought, okay, this is a hedge. It's going to protect me. Lower interest rates, the old arguments. So it became a very crowded space, and I saw it would open up in the morning when there was bad news fairly aggressively, and then kind of sell off. And mostly the ETF GDX, and that's interesting to talk about, was showing me this behavior, and it tends to lead gold and silver by a little bit. So it would open up fairly aggressively and then sell off and end the day red. And that's one of those moments where if you short it and the stock market continues to go down, you make money because people liquidate. If the stock market turns around and goes up, it also goes down because risk on is returning. So there are moments in these correlation regimes where you can spot really good risk rewards. So I spend that's why if you know these assets well, you can read these things. When I was younger, I wanted to be master of the universe and track the ups and downs of the Botswana Pula, right? and treasury notes in Nigeria, and that to me it was wrong. I would have done better sticking, particularly in crisis, particularly with high volatility, with a few assets. So mostly there, I'm trading shorter term opportunities, and I also noticed that behavioral macro. I've posted all my results over the past years. You can see them in times of volatility is when I've always done best on the trading side, not necessarily on the investment side, but on the trading side. So I'm trying to focus on that. S&P, NASDAQ, silver, and gold, and occasionally bonds.
Hey everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. Yeah, I mean, as traders, I'm always making more during the volatile times of my trading, and my investments are all going down. And it's always like, that's just something that we used to always talk about on the trading floor. We'd be like, when the market was tanking, we'd all be doing better than we've ever been have done in the past. But yet all of our investments were going down. And because so many traders are investors, and you wear both hats, for the people listening to this, most of the people listening to this are traders, but they also do some investing as well. What would you say, I think, to the investor side of everybody out there? Because we just kind of heard your thoughts on the trading side. What would be some of the things you'd be looking at to do with the market that we're seeing right now?
So, these things are very specific to the individual and their risk tolerances. But there are tricks that may or may work for you. So, people listening, just take these things with caution. They may or may not be appropriate for you, but they kind of work for me. So one of the things I do is I look for assets that I like that might be a little bit more illiquid. And, I leave what they call, I've learned the term recently, stink bids, right? Bids way below the market. You'll notice that crazy things happen. And we're going to see probably some of this in the ETF space, and we saw it in GDX on Friday. We should probably talk about that. You leave these stink bids in there, or you leave alerts to the stink, that an asset is traded down 30%, for no good reason. It doesn't usually trade like that. Some guy hit market order with a fat finger instead of limit order, and it's an illiquid asset at an illiquid point in time. So to give you a very concrete example, HOV is a home builder, and they've had, it's a heavily levered one. When the crisis hit, they levered up too early to buy more land banks, and it's taken them a long time to work their way out from under that debt burden. They still have a lot of debt, but they've moved the maturities out. But it's not very liquid anymore. And on Friday and a couple days last week, it would drop. It's got a 10 handle, and it drops 3 points, right? And then over the course of the day, it comes back up as people, as rationality kind of kicks in. Those kinds of assets for individual investors that are interested in like closed-end muni funds, where the retail base the ownership base is highly retail oriented and more prone to panic. Find assets you like and either set an alert or a stink bid below. Now, if you set a stink bid, you might get filled too early, right? If you just set it in the machine. If you set an alert, it might happen so fast that you miss it. But that's one thing that you can do if you want to, get yourself back in. It's also completely acceptable to stick with the plan. A lot of people now have balanced 60-40 balanced portfolios. Don't stick with the plan. It may take us a couple years to come back, but we will. And to get out and try and get back in, unless you're sitting in front of the screens daily, is really, really hard. In fact, it's really, really hard even if you are sitting in front of the screens daily. So you can stick with a plan. That's totally acceptable. Just don't panic. We'll come back from this. It may take a while and be more brutal. If you're more active and you've already got yourself in a position where you have some cash, using the stink bid method to benefit a little bit from the volatility might help. Now, I mentioned ETFs a couple of times and GDX. I don't think they're a systemic risk, but I think they're a serious mark-to-market risk, especially the levered ones. GDX is not levered, but we saw on Friday it went from 22 to 16 and a half in a nanosecond.
I know. I'm looking at that chart when you mentioned it, and I'm because
look at the intraday chart.
That's what I'm looking at. I mean, wow,
amazing, right?
Yeah.
So that we're probably going to see more from that from ETFs. Now, that was probably some combination of market maker slippage and not being able to keep up with the destruction and creation of ETF shares. And it could well have been as well. And my instinct that there's some of this, for sure, some of this. An asset manager gets tapped on the shoulder or just decides, I don't care, just get me out at any price. And I've been in the room with people who have said that. I mean, I've seen it in my professional career. So I think that kind of thing happened, and expect more if you hold illiquid ETFs, and you might want to get out and look for a chance to get back in via stink bid or something along those lines. But the ETFs and the algorithmic trading and the move to passive is going to exacerbate these moves, even if they're probably not the systemic risk that people make them out to be, because the banking sector is not levered. The real risk, because if the oil industry, shale industry blows up, they do bankruptcy, new guys come in with capital, the assets still exist, we can still produce shale. It's not systemically important that the investors be protected, right? But when banks go down, we can't get our deposits. We can't get the money out of the ATM machines. And that's where we were in 2008. That's not likely to happen this time. And not only because the authorities are on it, the generals are always fighting the last war, but also because the banks are much better capitalized. So I don't think these ETFs are going to be a systemic threat, but I do think they can cause extreme mark-to-market pain, which begets more mark-to-market pain. If you or I lose all our capital, it doesn't matter to the system. Right, but if a Citigroup goes down, it matters to the system. That kind of thing.
Yeah, one thing on your stink bids, that's one thing in the world that we live in now, in an algo trading world, is that they deliver prices that you may not thought you could ever get. And if there's something that you like, I do this a lot of times on data points as an intraday trader. I'll look at a number and I'll be like, okay, if this number, what's the worst case scenario or the best case scenario to where I think if this comes out, we could get to this area. That's an area to where I go, well, I think the market was maybe really smart, but actually very stupid, right? Like the algos will read it, but they took it to an area that I felt was way out of whack for what that news would be. And I always have those scenarios, and I don't call them stink bids, but yeah, those are the opportunities that I think you could look. And I really like that for investors out there. If you do your homework and there's something you really like, if you put something out there for a price that you may want, and you have your risk as to what, I always say, know where you're wrong. That might be a great price to you, but also know where you're wrong in that, and you might get it, right? I mean,
no, and listen, if you buy something at a 20% discount like that, I said stink bid is a term I learned last week. I saw it online, but I knew the concept.
Yeah.
If you buy something 20% down, doesn't mean you're not going to be underwater on it. It just means you have a better margin of safety. And the other thing I'll say is, a lot of people want to get the stocks buy the stocks that go down the most. That's not what you want. You want to buy the leaders, the ones that are going to survive. You don't want people with maturities falling due, heavy maturities that they might not be able to roll over, falling due in the next couple of years, just in case. You can afford to buy the quality names, even if they haven't fallen as much. Pay up and buy those. It's a much better strategy. I wrote a piece on for the blog called "Misunderstanding Liquidity," and I wrote it in 2018 in December, basically at the very bottom, because I think it was mistaken to think that was as Fed triggered as the market narrative suggested. I think a lot of it was the algo cascading that we were talking about, the ETF waterfall, that those kinds of things drove it down very sharp. It wasn't as vicious as this sell-off, but it was extremely vicious relative to the nature of the shock. And I think that has to do with the new financial architecture that we're facing. The piece talks about three different kinds of liquidity. The first is systemic. That's the Fed making sure the plumbing is working. Now, they can put all the liquidity they want in the plumbing, but it doesn't mean that we're going to use it if our risk appetite isn't there. The other two types of liquidity are directly related to risk appetite. One, transactional liquidity. Market making. You and I know this very well. You just look at the ultra bonds and you see it. When times get wild, people aren't willing to make markets the same way as they did before. Bid ask widens out, and in the credit markets, you get the matador bid, where you see someone sends you a run with prices, and you call, and they say, well, you said it was at 73, and they go, well, yeah, but that was an indication, right? And all of a sudden, the bid is 5 points lower. So you see a lot of the liquidity, transactional liquidity dries up, and that's really a function of our willing to take risk, and not a function of how much liquidity the Fed has put into the financial plumbing. The second type of risk is credit risk or rollover risk. Everyone talked about zombies and how low rates were encouraging zombies. Low rates don't encourage zombies. It's really about rollover risk. Are people willing, when that maturity comes due, are people willing to extend it? Are they willing to roll it over? And it's not, and people prefer to lend at higher rates. So lower rates don't encourage people to roll over, lenders to roll over. There must be another reason if they're willing to do it, and that's risk appetite. We understand why everyone wants to borrow at low rates, but we don't understand why people want to lend at low rates. They want to lend at low rates because of risk appetite. They feel confident. And so rollover risk is a big deal. Market making risk, liquidity is a big deal. Systemic liquidity is not a big deal right now. I think they're on it.
Getting to the market making risk, you and I were talking prior to this about how this is my 21st year of trading. I have never seen bond market movement like this. It is, I'm typically a treasury trader. I trade the 10-year ultras. And going back to what you had said is that, everyone calls them the most liquid markets in the world, but yet when no one knows what to do, I'm not working bids in this. I'm not working offers in this. The only time I'm working an order is when I'm getting out, because almost everything I'm doing is at the market at this point. As traders, we understand this, because it's like, even if I love a price right now, I'm not working a bid or offer there, because until I see what it does when it gets there, I don't want to be in and underwater on a day trade. As a market maker, really all of us are out there that are day trading, are making our markets.
Right.
Why would you want to put that risk out there? So I think that is. So I want to ask you is, with what you're seeing in the bond market, first, have you ever seen anything like this, and just your thoughts on it in general?
Yeah, I haven't seen anything like it. So I'll say a couple things. First, this is a perfect example of how the Fed can put trillions of dollars into the plumbing, into the Fed funds system, right? Which is kind of trapped there, and have no impact whatsoever on the risk appetite that bond traders need to go in and out. So exactly. That link that people think is there, it's really not there. And if you didn't understand it before, you pretty much have to understand that now. We're seeing it in real time. Second, I think part of this has to do with the new regulatory architecture that I referenced earlier. The banks are under much more scrutiny, under much shorter time frames, in many different directions. There's the liquidity credit ratio that they have to maintain for their liabilities, right? And then there's their capital cushion that they have to keep in case their assets deteriorate in value. Two separate things. They've got many other things that they have to track to make sure that they're in compliance with being a healthy bank that is not at risk of bringing the system down. Some of these things might be impinging upon banks' willingness. It certainly was the case in the repo flare-up that we had in September, but impinging upon the willingness of banks to make markets. And the Fed is on that. They're going to look at it, and I think over time they're going to fix that. Not going to be able to stop people from not wanting to take risk, normal guys, like you and me, but at least the banks are going to dial back their risk as well, but they dial it back much more in a regulatory environment that's become more rigid, and in one where the conveyed expectation of regulators are you better not screw up, right? Because we're all looking at the past. So I think some of it will get better. It's to some degree, but until we get out of this environment, all assets that trade are going to be wider in their bid ask, and the market making less robust.
And the thing is, rightfully so, because of all the reasons we just talked about.
Yeah, that's how it happens. The one way to think about the reforms that they put in place, because a lot of good things were done, but some things that weren't so good. Regulation is. I mean, my view was the large part of the reason we got into the crisis in 2008 was because there was no regulatory framework for the shadow banking system. It was a new thing. We hadn't heard of it. And if Greenspan or Paulson or whomever had come out, whoever the Treasury Secretary was in 2004 and said, we think too many people are getting mortgages. I think it's a little risky. We need to dial that back. Any congressman that supported them would have been out on their butts. You're against the American home ownership dream, right? Yeah. You can only fix regulatory frameworks in hindsight. That's a problem that democracies have. And that caught us. That caught us here. And then after the crisis, we do two things. We tend to make two mistakes. We do a lot of good things, but we also tend to overcorrect, and we fight the last war a little bit too much. And so, to sum up the regulatory changes since then, I would say the capital cushions are much more robust. So the chances of a fire starting are much lower, but the number of firefighters able to respond have been cut back. So some of the tools that were politically objectionable, that were used to kind of bootstrap our way through the crisis, have been taken away. So it's the system has become a little bit less flexible, but much more protected. So less firemen and less tools to fight the fire, but a much lower chance of fire. I think that's the right way to characterize it.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. A couple of questions before I let you go. You already mentioned Crudele a couple times today, and I got a little bit about your thoughts on it, but I think it's undercovered right now from the media, and I know obviously and rightfully so because of everything that's happening with the coronavirus, but what do you think about this and its impact on what we're seeing in the market?
So I don't think it matters so much. I really don't. Okay. And I've been saying this for years. When oil goes up a lot, so oil basically, two things have happened. One, oil as a share of our wallet has declined dramatically. It's gone from 9% to 4% or whatever the proper number is, and it would be at a lower level if local authorities hadn't been increasing local taxes on it, because it's it's an effective way to get money, and it's environmentally friendly, so you can sell it to a large portion of the population. So it's much lower portion of our wallet share, and it doesn't drive the consumer. We saw this when it went up, so that's one thing. It doesn't help the consumer as much as it used to. On the other hand, we have more oil producers here, so the economic hit from the production side is going to be greater. However, as I said, they're not systemically important. They can, yes, it's important for guys in the markets because it's a higher share of the high yield market than it is of the S&P 500. The S&P 500, it's not really an issue, but for the oil markets, it could get structures to unwind and it could trigger some cascading. So that's there. But from a systemic point of view, I don't think it's that important, and we're conditioned a lot of us have lived through a lot of oil crises and oil driving the bus in terms of the economy to a greater degree than is true today. And we're kind of anchored on that past. And this is why, a lot of people were surprised when the correlation between oil and the S&P, the inverse correlation didn't work. In fact, it was positively correlated because since futures trading went electronic back, I think it was 1999. Correct me if I got the date wrong, but since then, a lot of other people have gotten into it, and instead of being 70% commercial trading and 30% speculation, it's inverted. So oil tends to be has tended to be, when not in crisis, positively correlated to the S&P because it's spec guys risk taking, right? So I just don't think, it will hurt people in their P&L, but I don't think it's a systemic issue, and I don't think it's a massive issue for growth. It's what's different today from the oil crisis, the pop in the oil bubble in 2014, 2015, is that we're ready for it. Not only is we saw the bubble popping in 2014-15 was a big surprise. No one is surprised now. If you look at my tweets, you can see I've been saying oil is dead for about 3 years. It's just in the path of dying, right? And the oil companies that everyone has been trying to knife catch, instead of we kind of look at equities. We look at equities as discounting an infinite earning stream. Well, now it's finite. We don't know how finite. But all of a sudden, we've got to truncate those cash flows at some arbitrary date and discount those back because after that, they're not going to be there, or at least some of them not going to be there. Many of them are going to die. And there's a lot of leverage in that system that survived the 14-15 crash that's going to come out now. But the bubble popping, which is the big expectation shock, didn't manage to push us into recession. And I don't think that matters that much now. The coronavirus is a much bigger deal and will probably push us into recession. It's hard to escape that thought. But oil itself doesn't worry me too much.
Last thoughts for today. We talked about a lot of different things, and you with your trader hat on right now, we just saw probably the wildest week, I don't know, maybe ever. As long as I've been around, it's the wildest week I've ever seen. Going forward, what are you looking at? What are you focusing on? What are you preparing for in the coming weeks in your trading?
I'm looking. I expect more volatility, but I'm watching the volatility markets closely. If you want to think in the very simple terms, to go back to what I was saying earlier about Minsky cycles, if you want to call them that, starting very risk averse and ending the cycle extremely risk prone, risk inclined. In liquidity and volatility terms, it starts with volatility being high and everyone being afraid to take volatility risk, and liquidity being low and everyone unwilling to take liquidity risk. By the end of the cycle, we have layers of people that have built in structures and strategies that try and capture illiquidity premia and volatility premia. And we don't know how those unwind when things get as volatile as they have now. I remember I guess just a little bit before the crisis in 2007, a little bit of a canary in the coal mine, we saw Korean exporters that had been, and we saw it in Brazil to some degree, a little bit in Mexico, to a lesser degree in Turkey, but in a lot of emerging market countries, the trend in the dollar weakening had been so strong and so pervasive that they took it for granted, and they were pre-hedging their, in a certain sense, export receipts, right? So they were trying to sell the dollars now rather than to wait for those dollars to come in because they thought the dollars were going to be less in the future. So they were doing that by going, without getting too complicated, by shorting certain strikes and certain volatility strikes and instruments that blew up on them as soon as things started to reverse. There are some similar structures like that now. We don't know how many. And they make things very treacherous. We just don't know how it can go, but just layers and layers of things build up over time, as we go from the basement to higher floors, to return to that metaphor. So I'm watching that space very closely, and related to that, I'm looking at correlations. They're all assets that all of us have assets that we know really, really well. and we know how they're supposed to behave in different volatility regimes and risk on, risk off regimes. Watch those for anomalies. Those are the things I look for. And once those start playing out, we know we're closer to the end. We might be seeing the beginning of some of that.
Lastly, we talked about the coronavirus a lot today. Your connections to Italy, you've been on top of this relatively early. What are you doing to prepare for the coronavirus?
Personally?
Yes.
Oh, well, I have a really good setup here in that no kids in the house, and my wife isn't here either. So, and I work from home. I don't, have a job where my income is going to get cut off, kind of thing. I'm not in that position. So, for a guy my age, I'm vulnerable, probably not to death, but to hospitalization. And there are people who depend on me. So, I'm taking all the precautions, and it's relatively easy for me to do so. So I'm not someone you should worry about. The people we need to worry about are working parents and people whose incomes are going to get cut off, from basically things being shut down. I mean, there's that tendency, like as we were talking about earlier, to say, well, everyone's always crying wolf, the bear who cried wolf kind of thing. And it's not that bad. It's only the flu. And it gets reinforced through certain, media channels and obviously from the administration. And people want to believe that. We want to believe that our lives aren't going to be disrupted. We're paying the price in some sense of Western individualism. In Europe and the U.S., we have democracies and a lot of independence that they don't really have in Asia. It's costly for politicians, very costly and risky for them to tell us to ask us for sacrifice, and so they don't. And it's difficult for us to recognize that we need to sacrifice, so we don't until it hits us in the face. A lot like the regulatory blowups we were talking about. And so once, I was a little slow in recognizing it, but once I did, I realized the nature of it as a risk manager and said, okay, go aggressive early, right? You cut your positions early, don't Texas hedge, all the rules of aggressive risk management. So I think that's what people need to do. Listen to experts. They know, had they been allowed to speak more freely and more pervasively at the outset, we would be in a much different place right now as a nation. We're the most advanced country in the world, the United States of America. We've got the best technology. We've got the best scientists, and we should be out in front of this thing. We should not be hoping to be as good as South Korea. And no disrespect to South Korea, a very advanced and sophisticated society, but you know what I mean. So it's the bigger the economic hit we take in the short run, the better we're doing on mitigating contagion. That's what the experts seem to be saying, and the experience in contrasting Italy to South Korea and their responses tell us we're going to pay a price for our individualism, and just hopefully people get on board early and aggressively, and the people who are making the big sacrifices. We need to protect them. We need to compensate them, and above all, protect the guys on the front line. These guys are the firefighters. These are the guys that are parachuting in to put out the forest fire, the guys that run into your house to save the baby, right? These are the guys we need to protect. And if it means more taxes or whatever it means, we have to do it. It's, like I said, it's wartime footing. That's the mentality. I think we need to get into it, even if a small portion of the population is going to die, right? The numbers are big enough. 3% of 40 million or 2% of 40 million or even 1% of 40 million is a lot of people.
Yep, no doubt. Mark, where can people find you on Twitter, and give us a website to check out?
Well, the open Twitter account is Mark_Dow, and the subscription one, which put in the plug as it were, it's just $30 a month, and it's not if you sign up after 1 month and it's not for you, it's not your style, you're not getting what you want, you leave, and it's great. If you like it, you stick around for as long as it works for you. That's behavioral macro, all one word. And the website is behavioralmacro.com. Some of the posts there are open to the public, and some are for subscribers only.
Mark, what can I say, man? I mean, I learn so much from you every time we speak. I can't thank you enough for taking the time on a Saturday morning to speak with me. I wish you well. You got all the animals with you? Because
No, they're all here. They're all good. So the animals are fine as long as I can't catch the virus from dogs, from petting other people's dogs. I'm okay.
I know, but my dog is with me everywhere I go. I took her for a ride the
Right.
other day, and we went and stocked up on pet food. It was just me and her for the day. But like I said, Mark, you're a great guy, good friend. Thank you so much for joining me on Futures Radio Show.
Thanks, Anthony. Be safe.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.